Unnecessary crap.
All right, we're gonna get going right on time. We've got about an hour today and it's about 5:04. So we have people online and here in person. So welcome to our first client event in our new space and our first client Zoom event in this format. So thank you for being understanding of any technical difficulties. And we are recording, so everyone know who's online. Any questions you might ask of Brian at the end of the presentation, just know that we are recording today. We wish that we could have had our normal client Christmas party that you've all been going to for so many years, and we can't because of, we know the circumstances in which we have been living under, but thankful to the vaccine, we were able to have a vaccine only event tonight. So thanks to everyone who's here under those terms. It's the first gathering we've had in this space, so it's very special. And even though that we can't have our normal Christmas party, this has been a wonderful substitute to get us feeling a little bit back to normal and seeing some of everybody's faces. 2 years ago, we set out to build out this space. I walked through it right before the pandemic. We signed the lease the month after the pandemic started, and we sat with an empty space in the middle of the pandemic having to do a build out. And it was the hardest thing I've ever done in my life to try to do a construction project in the middle of a pandemic while everyone's working from home. We had a vision that this place was going to be this huge room here, that we'd have educational events and board meetings. We'd do our Christmas party here. And COVID really did ruin a lot of what we bought. We had this huge space and we weren't able to really take advantage of it. So we spent the year doing this beautiful build out, and thank you to everybody who was a part of making that a success, because the space has turned out really beautiful. If you haven't seen it, come visit. We're really proud of this space and we're happy to finally use this area. So anyway, enough about me. And for those who don't know me, my name is Allie Chris. I'm the president of Financial Insights now. Wow, it's been a long run. Thank you to Dorothy Lewis and Mike Dunbar. Wow. Quite a legacy, 1981, 1982 with Mike Dunbar and Dorothy Lewis, starting up both of their respective firms and passing on this wonderful legacy to the next generation, to myself, to Brian, to all of our amazing staff, who's now 14 strong, and we're growing every day. And wow, we have such a blessing here in Tacoma to be a part of this firm. So thank you to Dorothy and Mike Dunbar for everything that you've laid the groundwork for us. We're very, very thankful. And I know all of our clients are thankful to be here as well. I know a lot of you have been here since the 80s, and we thank you as well. So anyway, and the rest of the staff will help make tonight possible. We got Hannah Elkins, we have Lori Roberts, we have Katie Stein, we have Liliana Huerta, and I don't know where she's at. We have John Walsh, and wealth advisor, financial advisor, who's here as well. I think I got everybody. Oh, and Karen Springstead, how we cannot forget Karen, who's absolutely wonderful. I'm sure most of you have spoken to her on the phone. So anyway, everything being said, we're happy to be here and happy to welcome in 2022. So we're gonna do our holiday economic update. So Brian joined us during the pandemic from Brighton Jones up in Seattle. Now that we are a larger firm, we have a full-time chief investment officer, and that is Brian's role. Daily duties and kind of overarching job description is he's basically monitoring the overall investment portfolios, and he is doing a lot of the research in tandem with Daniel McCaffrey, who's here on our online. Now we have a basically dedicated investment team that we have dedicated investment only staff. So this is awesome. Back when we were a lot smaller, your advisor was doing investments, doing the trading, doing your planning, taking your phone calls, and now we're able to kind of have dedicated people in each areas. Brian brings, I believe, over 26 years of experience. He's a PLU alumni. He's a chartered financial analyst. He's really nice as well. He's a cyclist, and he bikes it to work during the summers all the way from the peninsula, which is quite impressive. Key Peninsula. So he has a lot of really good things to share with us. So welcome, Brian. Let me get us over and share. Again. Let's talk about the economy and interest rates. Let me share our screen here. Here we go. Share. And then, oh, I got it from the beginning. Okay, from current slide. All right, Brian, take it away.
Okay, well, thank you, Allie. Thank you all for being here. It's great to see all of you in person. I know that challenging that way. So thanks to all of you for attending and attending via Zoom also. You bear with me, I have a few notes for this presentation, this discussion, and so I plan to refer to them as I go, just FYI there. What we plan to cover today is a review of COVID's effect on the economy and financial markets. We'll look at where the economy stood going into COVID really briefly, and then we'll talk about some of the impacts that it had on the economy. Those impacts were pretty substantial. We'll talk about what policymakers did to respond to those impacts. And then finally, how do markets and the economy look today? And then the final topic will be about inflation, just because that's a hot topic as of recently. So that's the agenda, these three main areas. And so let me first launch into, first let me back up one moment. What we plan to do is also have a Q&A session following my comments. So feel free to fire away at me and or Daniel, who's attending via Zoom, can answer some questions. But I plan to kind of cover these topics first, and then we'll go into Q&A from there. So how did the economy look going into the pandemic? If anybody can guess what the unemployment rate was, it's actually up here, 3.5%. That was a 50-year low. This is late 2019, these numbers. So gross domestic product, that would be your economic output of the economy, was at 1.9%. You would say that that's not shooting the lights out, but certainly positive and been in that neighborhood for perhaps the last 5 years or so going into it. Inflation, the Federal Reserve targets inflation. They want inflation to be 2%. Some inflation is good in their mind, but not too much. So they're targeting 2%. We were a little over that, so I would call that within range as well. And then finally, what about the consumer? The consumer drives 2/3 of the US economy, or more than that. How was the consumer faring going into COVID? Quite well. That's $14 trillion, over $14 trillion, almost 15 trillion. And so as of the end of 2019, that was actually over the 5-year average heading into it. What do these numbers tell you? They tell you that the state of the economy going into COVID was actually pretty darn solid. You had good unemployment numbers, solid GDP growth, inflation that was fairly decent, and a solid consumer. So what happened when COVID hit? Well, if we all recall, there was a big shutdown of the economy, not only here in the state of Washington, but throughout the country. That had big implications. So this is just highlighting some of those points. 50-year low of unemployment, what I would consider reasonable economic growth, inflation was under control. So what did COVID and the shutdowns do to the economy? Well, one of the first measures is to look at jobs. And so looking at jobs, this is a chart that will show you job additions or subtractions year over year, month over month. And the shaded portion, anytime you see the shaded portion on the chart, that indicates a recessionary period. So it kind of gives you a sense that's when the recession took place in 2020. One note about this recession was that it was one of the shortest recessions in history. I believe the shortest recession in history. But if you'll notice in this chart, what stands out is, of course, this bar being far greater than all the other bars, maybe even combined, who knows. The economy lost 20 million jobs in April, another 2 million in March. And so things were hit pretty dramatically with COVID and the shutdown of the economy. That's really shown in the job market. I have my little captions here, so bear with me. Massive effect. Unemployment reached 14.8%. They started measuring unemployment in 1948. And so 14.8% was the highest reading they had. Of course, some people might ask, well, what about the Great Depression? If they had been measuring it, it'd probably be a little bit higher than that. I would think in the 20s, what I remember. So what did that do to financial markets? Well, financial markets are often called a leading indicator of the economy. And so what you saw was in February through late March, a sell-off in markets. The S&P falling a total, this is peak to trough. So peak being in early February, trough being March 23rd, 2020. The S&P fell 33.8%. International stocks fell almost the same amount, whether it be what we consider developed. Those would be like United Kingdom, other countries in Europe. Emerging stocks would be something like Brazil, Russia, India, China, something along those lines. Point being, all these markets fell dramatically in a very short period of time. As a matter of fact, the S&P fell 30% within 22 trading days. That's the fastest decline in history. It's amazing how fast it fell. And it fell in anticipation of the recession being declared. So again, it was actually somewhat a leading indicator. And notice the good news was, while bonds were negative, far less negative than they were in stocks. And so that's actually somewhat of a diversifier benefit in holding bonds in your portfolio. So one of the things that really drives the economy, as I mentioned, U.S. consumer drives 2/3 of economic output. And what this slide is showing you is, this is trillions, by the way. So 14.8 trillion dollars going into the recession for COVID. And look, it dropped over $2.5 trillion in a very, very short period of time. The good news is there were a lot of stimulus measures that went into effect down in this neighborhood somewhere. And you see this big rebound, which I may actually circle back to this slide to kind of give you a sense of where we're at since COVID. But we've rebounded nicely. As you see, the US consumer has actually taken off again. And that has a lot to do with what policymakers did. I'll touch on that in just a moment, actually. So 2/3 of the US economy driven by the US consumer. Spending rebounded sharply. Gross domestic product. So this is a measure of how the economy is doing. It's the actual measure that you hear quoted by economists. You'll hear gross domestic product in relation to recessions or growth per se. What you'll notice here is this is quarter by quarter, growth or decline. The economy declined by 31% in one quarter. To give some context to that number, how big it was, the Great Recession, gross domestic product declined by 4%. So it was massive. And this is partly why policymakers moved so quickly and put so much effort and so much money into stimulating the economy. They saw this and they realized what was happening. Shutdown really was a quote shutdown of the economy. You'll notice that it rebounded. Well, I'll get to these numbers maybe a little bit later, but quite a rebound as well. And there I have my caption, GDP falling by over 30%. So that is a very quick rundown of the impact that COVID had on the economy. The key being consumers were impacted greatly. Gross domestic product, it was reflected in. We saw that the jobs market and how that impacted it was massive. So policymakers had to do something about it, or they felt they did anyway. And I'm glad they did actually, because had they not, we'd probably be faced with some sort of depression. So what did they do? Well, there's a ton of things that they did, to be honest with you. The Federal Reserve actually made a ton of measures in a very, very short period of time. Within a month, they made all the efforts that they made for the Great Recession, the financial crisis. They rolled out all those programs again, which were numerous to begin with, but they added 7 other extra programs in support of markets. Why did they do that? Well, financial markets actually seized up. So there was actually very little cash flowing anywhere. People were unable to borrow. People were unable to make payroll. People were unable to pay very short-term debts. Why did that happen? Well, no one wanted to lend to anybody. Everybody wanted cash. No one wanted even bonds for that matter. And that's why you saw a little bit of a decrease in bond prices, that performance. It's because everybody just wanted cash and nothing else. So the Federal Reserve said, we need to do something about that. We need to be sort of the buyer, the backstop of last resort for financial markets, for stocks, for bond markets. So they created all these programs, whether it be this primary dealer has to do with supporting banks. Commercial paper has to do with very short-term lending for companies to, there's secondary market that had to do with actually supporting bond markets and supporting, in some cases, other types of assets. This term asset-backed securities loan facility, that was part of the Great Recession. So they actually rolled that back out. All of these combined, you'll see in a moment, resulted in a huge increase in their balance sheet. And that increase in balance sheet, you could think of as the amount of money they threw at the pandemic. It was massive. So here is their balance sheet. So this is an idea of how much the Fed is actually holding in financial securities. What you'll notice is that it was over $4 trillion going into, I think that's, numbers might be wrong here, 2020. Okay, yeah, here we go. So it was over $4 trillion. So you're thinking to yourself, $4 trillion, why are they holding $4 trillion in 2020? Well, that's sort of leftovers, if you will, from the Great Recession. They still had money, still had assets on their balance sheet going into 2020. And they were actually trying to let that run off, let bonds mature, and actually shrink their balance sheet. But what they found out was when COVID hit, they needed to do something quickly. You can see the shaded period here again for the recession. Notice what happens to the balance sheet. It increases dramatically in a very short period of time. You're talking about 2 or 3 months. It went up a very huge amount. You're talking about $3 trillion. Right now, the Fed's balance sheet is just under $9 trillion. So it went from a little over 4 trillion to 9 trillion, basically doubling, if not a little bit more. So you could think of the Fed threw almost $5 trillion at the economy to get markets functioning again. It's amazing. These little squiggly lines are the monthly bond purchases that they're continuing to make as of today. Tomorrow they're meeting, and you may hear of them tapering. What does tapering mean? It means basically reducing the amount that they're purchasing. They're still going to be buying bonds, but they're going to be buying less. And they're going to actually try to do this and end it sometime in March, is probably my guess, March of next year. And then the question will be, will they then shift to rate hikes from there? And we'll get to why they're doing that in a moment. Why they're reducing their purchases and why they're actually talking about rate hikes at some point. So you'll see a massive expansion of the balance sheet, over $4 trillion. The Fed's balance sheet actually has a very large influence on financial markets because they are still a presence. They are still a buyer of securities. And so if they start reducing their purchases or start selling securities, that has implications on prices for securities, and that has implications for investments. So I'm sorry about the Zoom here, sort of crowding out the title, but basically what this is saying is that policymakers, so this would be the government, it would be Congress, it would be the president, it would be those that are making laws, passing bills. What do they do in support of helping the economy overcome COVID, that is? They did a lot. They did, so you might remember that this is sort of overshadowed. They aided the quickest development of a vaccine in history and the deployment for that matter. That was huge. I mean, we probably wouldn't be sitting here today in person without those vaccines, of course. So, I mean, that's a big deal. And that happened really rapidly. The average vaccine, I believe, was, the duration of development was somewhere around 5 to 10 years, 5 being sort of a minimum. So as far as the bills are concerned, you probably heard about all these bills, but here they are listed out. There's 6 of them. These total over, I believe it's over $5 trillion, $4.5 trillion. That's a huge amount of money. So we're talking about close to $10 trillion being thrown at COVID and re-stimulating the economy and getting it going again, getting financial markets on their feet. That's huge. Point being, one other slide here. This has to do with the PPP program. So this was loans that were forgivable to small businesses so that they could keep people from being laid off, so that they could maintain their payrolls. This was huge too, $800 billion. There were 11 million loans. And a number of these loans were actually forgiven. So you can think of that as money given to those businesses by the government, as long as they met the requirements for forgiveness. So it had a huge impact on the economy. If I go back a few slides, let me show you. I can go back. People went back to work. Jobs were re-added again. And so they started spending money again. And look at where it's gone. Demand has really taken off since jobs have been added back to the economy. Gross domestic product, it rebounded. Negative 31%, went up to 30, it increased to 34%. It's now somewhere, it's still increasing, but not nearly as much. 2.1% was the last reading. So that's a view of some of the current conditions. So what happened with financial markets? Where are they now? What happened after all those interventions, after the big drop that you saw early on? The US, since the market bottom in March 23rd of 2020, is up 110%. These are cumulative returns, not annual. 110%. So not only did we rebound entirely, but we're actually up relative to the end of 2019. Japan, maybe not so much. European Union, China, not so much. The UK, pretty close. And these are gains since the end of 2019. Where is the economy now relative to 2019? Excuse me. The US has actually gained a little bit. Japan is still down. European Union still down. China has rebounded. Some people question whether these numbers are actual, China's reporting sometimes can be a little suspect. And then the UK down considerably as well. The good news is they'll look at financial markets. This is why your stock portfolio, your portfolios have still done reasonably well, in spite of all those big declines that you saw as far as jobs, gross domestic product, consumption. Because of those huge interventions, you've seen financial markets actually weather this quite well. And actually, it's the fastest turnaround in history going from a negative 33% back up. So what else do I have here? So they're still recovering in other major developed regions. So the point being here also is the US has done quite well. International stocks, maybe not nearly as good. So maybe there might be a little bit more opportunity in this space. What we do know is that we already have exposure to those international companies. So there may be opportunity for returning them as well in your portfolios. Let me see what else I can say here. Oh yes, variants. So we now know about Omicron. Many of these things could turn around potentially if economies have to shut back down for one reason or another. So variants are always going to pose a threat. They're always going to add an element of uncertainty in some of the projections for economists and or financial markets for that matter. Let me see here. So one of the key topics in discussing where we are today is inflation, because everybody's noticing now that prices are increasing. You hear you view the headlines, and as a matter of fact, Google search activity is reflecting it. With the media being abuzz, people are starting to react to it. So this is 2021. You'll see that search activity has spiked considerably when you include the word inflation in there. So this is the latest, these are the latest numbers that came out for November. This just came out a few days ago. All items year over year. So this is a year over year, November 2021 compared to November 2020. So remember that in 2020, there was actually fears of deflation. Prices were actually falling. Why was that? Well, remember the consumption graph that showed consumption falling considerably? That meant less demand for goods. And so then prices fell. People were talking about, is deflation going to be here? How worried should we get? Deflation is actually a very negative scenario for the economy because people keep holding off and buying things, expecting prices to drop further. And so it becomes sort of self-fulfilling that way. If I keep waiting, then consumption does not occur, and then the economy gets worse. In this case, so just keep in mind that prices in 2020 were low because they fell due to consumption. Now we compare the 2021 numbers against those. And so comparing November 2021 against November 2020, prices are up 6.8%. That's on everything. When we look at everything except for food and energy, why do they exclude those from time to time? It's because those numbers fluctuate quite a bit, day to day, month to month, week to week. And so because they have such a volatile aspect, they actually focus in on this number being a little bit more stable. And speaking of energy year over year was 33%. So November 2021 versus November 2020, 33%. And I'll show you why that was. Food up 6%. That's not a small number. Used cars and trucks. So you might recall the supply chain issues, the lack of chips, so to speak. That's a good reflection because people could not purchase new vehicles. And so they turned to used cars and trucks. And so that's, without the supply of new vehicles, then you turn to something sort of the next best option. That's why that number is so high. Rent is one area that economists are focusing on because this can be a bit of a sticky number over time. And so this 3% number is something they're keeping an eye on. If it stays at this level, they're going to get a little bit concerned about it. Notice finally that computers are actually down. Admission, this is to sporting events, actually down. Sporting events, go figure. Lots of people in the stands, probably not a large amount of demand there either. What else do I have here? So really, energy being a huge contributor, and supply chain bottlenecks. So you've all heard about supply chains. You've heard about many of the factories in foreign countries when Delta hit were shut down. And these factories are not the same technology as they have in the US. They actually take quite a while to restart and reman, so to speak, and get going again. And so it's been slow. It's been slow to get them going. And that's part of the problem. The other part is there has been an increase in demand. We saw the consumption numbers just a moment ago, that chart, which I can certainly circle back to. Supply and demand don't necessarily move in tandem as far as their speeds go. So demand can move much more rapidly than supply can, simply because you have to get supply back online, you have to get the factories going, you have to get shipping going and all that. Thinking about ships off the coast of California, for instance, probably heard about that, somewhere between 70 to 100 ships. Now they're, actually I just read that they're asking the ships to stay at least 150 miles offshore, so that to prevent congestion there. Most economies do feel though that those will be cleared out over time. The question is how quickly that will occur. And that's not something I know the answer to. Trying to remember. Oh, okay. So this is, so speaking of energy, let's look at one of the drivers of demand for energy, and that's driving your car, miles driven. So this, the title of this graph is actually miles driven on a monthly basis. So you can see going into COVID, it was about 272,000 miles per month just prior to COVID, and it dropped considerably. That's over 100,000 miles per month. So that really fell off, and notice how steep that is. Notice when the recession occurred. Now look at it, it's back up almost to the same level. And it did it in a very short period of time. It actually did it in a little over a year. Keep in mind that energy, anytime you're talking about oil production and things along those lines, it's not like flipping a switch. There is definite work behind trying to get the production back up to where it should be.
Can I ask a question?
Absolutely.
What is the second dip that between COVID and the new number?
Great question. I think that this reflects Delta.
Delta. Okay.
Yeah. Now there is some seasonality to this chart as well. So you'll see that miles driven will increase during the summer months and decrease perhaps a little bit in the winter. But yeah, that's a great question. So what do we have here? This, looking a little further at energy prices. This is plotting oil price per barrel against supply in the tan line here. And what you notice is that supply had gotten, this is all domestic, by the way. We don't have, the data for international isn't quite so easy to obtain. Notice supply being way up there, and actual prices were not too bad relative to supply being high. That would make sense, right? More supply, less demand, a little bit less demand, lower prices. And look what happened going through COVID. Prices fell off a cliff. Why? Because, well, we just saw that miles driven had dropped considerably. Now look at what happens with prices. So demand starts kicking in, right? We had consumption increasing. Look at what the price of oil did. Now look at supply. It didn't really increase. It almost kind of went sideways. They're just now saying that supply is starting to increase in a more sort of ongoing way rather than sort of up and down, so to speak. So it fell significantly in 2020. Supply has not increased to keep up with demand. Hence, you have higher prices in oil and higher energy prices driving inflation. You saw that 33% number.
Can I ask another question? The supply of gasoline refers to our vehicles versus, and so perhaps some of those numbers could be reflected by people doing road trips versus air travel.
Absolutely.
So that could impact that number.
You bet. Yeah, and actually, you probably see that here, especially notice the summer. That's sort of vacation season. Okay, so what does the market think about inflation? Where do they feel that inflation is going to go over the next 5 or 10 years? Well, there are actual bond indicators. There's bonds that incorporate inflation and bonds that don't, and they use the difference between those two to reflect what the market feels inflation is. So the green line is actually 5 years into the future. The tan line or gray line is actually 10 years into the future. And what it's indicating is actually not as bad as you might expect. I mean, when you see 6.8, it kind of gets alarming. I certainly thought so in seeing that number. But if you look here, this is a little over, between 2.5%, closer to 3% over the next 5 years, and even a little bit lower, around 2.5% over the next 10 years. What they have proven is that actual markets are actually pretty accurate with this number. And most economists actually agree that inflation will decrease, but it will probably end up higher than the Fed's target. You might recall that I said 2%. So that would actually agree pretty close to this line, in my opinion, over the near term. What's going to bring it back down? The answer to that will be sort of clearing of supply chain. So that means, having factories be online for a bit, having ships get unloaded, and hopefully clearing some of the backlog of those ships. But also what I've heard is that in certain cases, retailers have double ordered because they know they needed to keep their stocks, their inventory stock up. And sometimes it was even triple ordering, depending on. So that's actually created part of the issue. It was sort of self-fulfilling by trying to prevent not having those goods in their inventory. So point being is you may wind up with a little bit of oversupply in the end, which would put downward pressure on prices. So what are some thoughts around inflation as far as we're concerned? I've wanted to put together a few considerations. Short term would be, again, I said that 2021 results were compared to low prices in 2020. Variants make it very difficult to ramp up production in less developed countries. So that's the sort of the India, the Vietnam, some of the clothing is produced in a number of those areas that didn't have the same technology that we do here. Factory shutdowns I have here. So semiconductors are a big deal. Samsung is one of the major producers, has talked about ramping up production. So now the question becomes, here's demand, will supply overshoot it? It's a question to consider. Shipping backlogs have not helped. So that's certainly a short-term issue. Long-term considerations might be a little bit different. So most economists expect supply chain issues to be resolved. It's just a matter of how long that takes and how many variants occur along the way. Aging demographics. So baby boomers have retired, are retiring. So generally what they find is your peak consumption years are when you're at sort of the peak of your career, or you're having kids, you're buying a house. Those are sort of your peak consumption years as far as your age goes. And as you retire, you tend to spend a little bit less, maybe not, you're not making those big purchases, you're not, it depends. What I would say is they've done a few studies on that and found that actual aging of demographics can put a little downward pressure on inflation. Advancement in technology. So that's another factor that most people don't hear of much, but they've actually priced out an iPhone based on computing power, based on storage, based on all the things that it did. And they said, okay, what would it cost in 1991 to build an iPhone? And it was over $1.4 million. So you think about that, you know, and nowadays, because of the technology advancements, that's why we've come as far as we have. The point being is technology will continue to put a little bit of pressure on inflation in a downward measure. What are some of the risks in sort of looking at these two factors? Well, one is more variance, right? We know about Omicron. So what is that going to do with countries shutting down production once again? That's a question I couldn't answer right now, but hopefully vaccination status will only increase. And that will mean that perhaps they won't shut down nearly as much. Labor shortages are another risk. You've heard about companies having trouble filling positions. That's real. Perhaps more real in sort of the leisure hospitality area, mainly because those people have been stung once. And so they're wondering if they're going to get hit again. I've also heard about the quits rate. This is people leaving their jobs for something else. And it turns out that the hire rate actually corresponds to the quits rate. So a lot of people are changing jobs. But that doesn't necessarily explain the labor shortage per se, but it's an interesting consideration. I have a few extra charts that I might share if you're interested about a little bit of theory behind that. But labor shortages are real.
Question on that.
Sorry, go ahead.
Is this true in Europe as well? Labor shortages?
That's a good question. I haven't heard as much. I think that there is some labor shortage on that area, in that area as well. It may be for different reasons because you know, they're a little bit more on the socialist side, so they get a little bit more government support, which means their appetite for taking risk and getting COVID or what have you may not be nearly as high as someone that needs to get back to their job, needs to get going again here in the US.
I think it's higher in the UK.
The last factor is actually one of the biggest risks ever. That is inflation becomes self-fulfilling. What do I mean by that? Well, you decide that prices are moving higher. So, well, then I better go out and buy whatever it is I'm going to buy. If you do that, then that only pushes prices higher. And then that keeps happening time and time again by people. So it becomes self-fulfilling, becomes a self-fulfilling prophecy. And the expectation of inflation is something that's very important to economists. So what are people's expectations of it? What you hope is it does not become self-fulfilling, because stopping it might be challenging. So one of the questions you might ask is, what have financial markets done under periods of, say, elevated inflation? This chart illustrates a 1-year period, a 3-year period, and a 5-year period of what we would consider elevated inflation. And each one of these, there's inflation, there's US stocks, there's stocks outside of the US, bonds, and REITs, which are real estate. Inflation has averaged 2.6% since the mid-80s. That's actually a little bit higher than you might expect. The likelihood of above average inflation actually occurs during economic expansion. Why is that? Well, people get their jobs back, they want to spend money, there's sort of that appetite for consumption. What does the best? Stocks and real assets. So real assets being things like real estate tend to do the best under those circumstances. But as you note, sort of people saying that bonds are not going to do well in an inflationary period, I would point them to this chart actually and say, well, explain these then. So that's sort of a real quick overview of what happened with the economy. With COVID hitting, you saw the loss in jobs, you saw the decrease in GDP, saw consumption fall off a cliff. But then you saw the massive efforts that policymakers have made on the Fed and the US government throwing $10 trillion at this issue. And the point being is that markets were very resilient in the face of that. They experienced a massive rebound, and rebound, in my opinion, is an understatement. Actually, they've done quite well. Companies have actually bolstered cash reserves in case there's more variance and more shutdowns. But given the run up in stocks and waning support from the Federal Reserve, an increase in volatility next year wouldn't be surprising. There's going to be periods of uncertainty around what the Federal Reserve is going to do. There's going to be periods of uncertainty around inflation. There's going to be, anytime you start removing a little bits of stimulus, then anxiety usually creeps up in markets. So don't be surprised. Volatility is another way of saying you may see the market move downward, but followed by maybe a move upward at some point as well. So what's our approach in light of all these considerations? Well, you may not be surprised by some of the things I might about to say. One is make sure that you've confirmed your goals, that they're clear and you've identified them and articulated them with whoever you might be working with, whether it be Ally or someone else. Without them, the short-term factors that volatility next year, let's say, might lead to sort of reactive and ill-timed decisions on your part. It's hard not to want to do something when you see the market start to move. We recommend staying the course. So once you've identified your goals, we rely on long-term asset allocation, which is proven to be the major determinant of success in achieving your goals. Think of your investment portfolio as a tool in achieving your goals. That does not mean that we ignore markets by any means. It means that we actually monitor market valuations and rebalance toward our target allocations as conditions either warrant or periodically. We also are constantly monitoring markets for risks and opportunities. If we see them, we'll recommend changes that might be made. They won't be huge changes, but they might be changes around the edges. Resist the temptation to time the markets. So that means if you think markets are overvalued right now and boy, 2022 is coming, let me sell now. That's a difficult thing to ever accomplish in any sort of reliable way. Academic studies have reached the same conclusion. No one has been able to consistently, successfully time the market. Don't confuse experts' luck with skill. You'll hear them tout it. And then finally, remain diversified. The most powerful way of protecting against timing and worrying about what asset's going to do well next is diversification. So what I have here is every company. That could be Microsoft, not that long ago, or technology sector, or Japan. All these are examples of where you could see periods of poor performance that end up lasting a decade or longer, but we can't tell when that's going to happen. And this slide actually illustrates what I'm talking about. So this is what we either call a periodic table. Some people like to call it a quilt chart. What it's representing is all these different types of assets. Most of these are in your portfolios now. So that'd be large cap stocks, it'd be some developing country stocks, it'd be fixed income or cash, what have you. Notice anything here? There's no pattern. Year to year, there's no pattern as far as what's going to lead the show and what's going to be the bottom performer here. So these are ranked from top to bottom. It's a pretty strong argument for diversification, in my opinion.
Would you go through that again?
Sure. So let's look at 2008. I'll give you an example. Notice fixed income actually did quite well during that big sell-off in the market. But look at US equity. Large cap equity was down 37%. And look at where emerging market equity was. It was down -50%. Now look at it the next year, up over 78%. So it's very difficult to predict exactly what's going to do, what's going to outperform something else. So this is another slide, another argument against.
I just noticed your
Sorry.
emerging markets went from the very bottom 3 years ago to basically third from the top now. So I've noticed that in our portfolio too, where, yeah.
Right there, yes.
In the 2 years prior, it was in the very bottom.
So keep in mind that we size or we allocate so much to different asset classes based, one of the factors that we base it on is how volatile it is. So emerging markets is a relatively small portion of your portfolio because it's doing this.
Yeah.
Point being is if you blend all these together, you're going to end up somewhere in this neighborhood, a more smooth ride than up and down like this. And that's what we're after. You may not be the top performer, but you certainly won't be the bottom. This is another argument against timing the market. So this is assuming you invest $10,000 in 2006 and you hold it all the way through to current. And I think current was beginning of December I did this. And these little boxes are all about the events that took place along the way. There's quite a few of them if you notice. Lehman Brothers, 2008 sell-off, great financial crisis. You have the US downgrade, you might remember that. The credit rating of the US was in question by Standard & Poor's. You had Brexit, the UK leaving the European Union. You had the trade war, if you might recall that. That was in 2018. The market sold off pretty heavily in December of that year. And then you had COVID, and look at that big dip. Point being is if you held onto your money and didn't do anything but hold on to it, it would have grown to $50,800. That's all in the S&P 500, by the way, this example. Some other things to think about, the 7 of the 10 best days took place within 2 weeks of the 10 worst days. 6 of the 7 best days occurred after the worst days. And the second worst day of 2020 was immediately followed by the second best day of the year. So trying to predict exactly when those things are going to swing and when you're going to be able to capture returns, it's better to just hold on and watch it grow over time. So that is all I have. I do have some extra slides, but I'll leave those in the appendix for now in case.
Cool. Well, thank you, Brian, and I will say we're having a few minutes for questions and answers here. So if you'd like, Brian will be here to answer any questions. We'll keep it open for about 5 or 10 minutes and then we'll close it out. We've had a really big 13 years of a bull market, historically low interest rates and inflation that's hovering at close to 7% this week. So wow, there's a lot of questions you could be asking. So you have 10 minutes if you want to close it out if we don't have any questions for Brian.
There's 2 things in the chat.
Oh, there are. Oh, perfect. Here.
I can see it there.
We didn't forget about you, online friends. You're not hearing any volume.
Oh, they forgot to unmute it.
Hopefully, no, everyone's still there. So that was about an hour ago. So we're good. Hopefully you hear the volume now. So let me turn up my volume so that I can hear you. And if there's any questions from our online audience here. Okay, I've got volume up.
Oh, he's muted now. Don't know where the participants are. Don't know why we can't hear it.
Okay, so here's us now. What we're gonna do. Sorry, guys. So, and we're not gonna be able to hear you talk from online, but if you could put in your questions into the chat area, we can answer them from there. So thanks for a great presentation. We just turned off the echo. So if there's any questions, just write them in the little chat box at the bottom. If not, we're gonna close out here shortly. Yes, please.
Brian, I have a question about the recovery slide. You know, USA was at 110%, and then Japan and all the other countries.
Yes.
Is
I
that,
don't know why this thing's not working.
can you explain maybe why that is compared to those other countries? Is it the policies that our government put in place and those other countries didn't? Or
Great question.
is it the size of the population or?
You're, okay, so there's a couple factors in there. It's a great question that you're dead on at least part of it. So the stimulus that occurred in the US was far and away the biggest out of everybody in the world, for that matter. So Europe, Asia, you name it, did not even come close to measuring up to the reaction that we have. The other factor is vaccination. So that's the one that often gets overlooked, but we were the developers really of the vaccines for the world. I mean, there's AstraZeneca, of course, but, Pfizer and Moderna and Johnson & Johnson. So, you know, most countries are using our vaccine. So the percentage of vaccination was automatically a little bit higher earlier for us. Does that make
So
sense?
is that sustainable? I mean, like, and does it?
We would expect the rest of the world to start potentially catching up. One, why? Because of vaccination status, and two, because there's still opportunity there to grow their economy relative to where we are at currently in our cycle.
Yeah.
So.
Right. You talked a little bit about the one more big bill we have, the infrastructure bill, and how that might be viewed. I mean, if it's whittled down quite a bit, but I mean, overall, as a benefit to our economy and.
Yeah, so there's definitely going to be some stimulus as a result of infrastructure and the bill, and it's bounced around so many times it's difficult to even put a number on it. You will definitely see that. So what does that mean? Also, it could mean that could be another risk for inflation though too, because there's just one more stimulus added to the pot of stimulus. But I would expect to see some benefit from that. I think the state of Washington actually
Should have a definite return on investment. That's down the road at least.
hopefully down the road. It's going to take some time though, for sure, and for those results to actually show up in the numbers.
So I'm trying to figure out how to ask this question accurately. Gains from all of this are being felt unequally across the economic spectrum, with both the top 1% and all that stuff. I think my question is, at what point does the unequal gain issue become a threat to the overall economy? How many poor people can we afford to leave poor?
That's an excellent question, and one I don't know that I know the answer to that actually. You know,
I don't see that issue in the data.
That could be a
I don't
long-term
see anything that even hints at that kind of issue.
yeah, that I see that as somewhat of a long-term issue. I don't know that that's going to be felt in the next few years, but you could certainly see that coming over time. That's the only way I know really to answer that question, because I think part of it is policy, so economic policy, and that's really hard to predict at this point. Pat, do you have a thought? Or?
I'm just thinking how that works in with an analysis of the causes of the inflation. Because that inflation falls disproportionately as well. So And it seemed from what you've said, deflation and inflation are tremendously impacted by the perception of the consumer.
Correct.
So it makes me want to put my head under the pillow because I don't see how you can work your question and the issue of inflation in with the social problem that we have of the gap.
Yeah, that's, I mean, what I can say is that there are enough consumers in the, sort of in the middle area, if you will, to keep demand going. But that's a big issue. It's a big issue. Sorry, I don't have a better answer for that. It's one that I don't know, that I think that everybody's trying to figure out.
So this may be the ultimate dumb question, but I'm gonna ask it anyway. So could you tell me what it is that people who have X billion dollars foresee they can do with $2 more billion?
Oh,
Yeah.
yeah. Well, I mean, that's like sort of.
I mean, none of us are going to live forever.
I mean, that's the definition of gratuitous capitalism, as far as I'm concerned. So it's like, you know,
Go to space.
go to space. Well, I mean, the good news is he's also investing in trying to reduce carbon dioxide, so that actually has some. But I agree.
I thought you might have an answer.
I'll be back to you
So
on that.
funny.
I mean, it's just.
Well, the Washington State, back into the social, money going into the social aid, you know what, everyone, just something that we didn't touch on tonight, I don't think, was the Washington State capital gains tax that's coming in January. There's a $250,000 phase out that I'm not sure you're aware of, which I just learned about today. But the money from that capital gains tax is going to two different funds, one of which is an educational trust fund for children that have been disadvantaged socially and otherwise. And I did a little research because I watched the state legislatures today talk on it. And one of the Q&A questions was, what is this educational trust fund? They all sat there like, well, we don't really know. So I Googled it afterwards and found some of the money is going in that direction. But that topic is really interesting. I wanted to add it just in this room. I felt like it was important to a lot of
That doesn't
people here.
apply to retirement savings.
No, it's not retirement accounts. It's actually not your primary residence capital gains. It's not real estate at all. They've excluded real estate. So it's going to be the sale of investment assets. And there's a few other things that will fall in line there. And there's a few other things that are excluded. There is an exclusion though, that probably will mean most people will not be impacted by it unless you're doing some major sales in that year. It will impact sales of businesses, which if you own a business that you're planning on selling, I think it would be relevant to you.
Brokerage.
And brokerage accounts, sale of businesses, as of right now, it's not touching your retirement accounts or real estate.
What about commercial real estate?
It is, I believe that's, Peter, let me do some research on that. I don't think.
6 units or more.
Yeah, I was gonna say, I think there's some
Yeah.
sort of threshold for commercial. Yeah.
I read, when I read it, which was like 3 months ago, I thought it was 6 units or more in commercial real estate.
Well,
However you
they
define
could say that it was a state income tax, which is illegal in the state of Washington. So we're guaranteed to see a bunch of lawsuits on that come January, as well as see a bunch of lawsuits about the long-term care payroll tax for the exact same reason.
I thought they pushed them both down a road here.
No, the capital gains tax is starting in January. They did change it to where it's not impacting, I think, as many assets, but it is starting. I just watched the guy who's in charge of it, who's actually also in charge of the Washington excise tax that we all pay for business owners. Interestingly enough, it's the same guy dealing with both. But all the money is going into two different trust funds, all for a good cause. So it's
That's
not.
what they say now. That's what they say.
Well, it's not like the government is using it into other directions.
Well, they
It
took
is-
the RTA money and used it for other than the railroad.
Yeah, and I don't know what the other trust that it's going into is actually for. I just know the one
Yeah,
education
okay.
trust. I didn't research the other, so I misspoke. I don't really know what the other trust is for. I do know about the education one, but we'll learn more. The long-term care thing is going into effect but I think that it will, I can't say my personal opinion.
Not enough, not enough.
I heard the max is $35,000. $33,000.
Yeah.
Put your money, $5 a week into a checking account and you'll be fine. I mean, you'll have
Oh,
more.
to pay for the taxi.
If you're a young employee,
It's not enough.
It's not
Yeah.
enough,
What is
$35,000.
35,000 paid for?
Anyway, so we digress. What we're gonna do is we're gonna close out our online Zoom right now. We're gonna thank Brian for his time. Brian's gonna stick around, so after we shut everything down, if you have a personal question you wanna ask him, then feel free to. Dorothy and I are gonna stick around for a bit as well, so we thank you all for coming, and yeah. Yes, oh, we have one more question.
Well, having introduced that downer question a while ago, I want to thank you all for really good.
Yeah.
Oh,
Yeah.
you're welcome. Appreciate it. Well, thank you all for attending, and then we'll stick around, and then online audience, if you have any follow-up questions, you can email us. Have a wonderful evening, everybody. Thank you.